Welcome back, accounting superstars. Okay, we are going to continue our conversation with investments, and we are moving on to the amortized cost method for debt instruments. So just a little bit of a recap here. We have our little summary that we're creating. We haven't got to fair value net income or fair value OCI yet, but here for the initiation purchase, we will record the purchase at the fair value plus the transaction costs and any accrued interest for the bonds. Okay, if there is dividend income, then we would recognize that as interest income for holding those bonds. And then at the year end, similar to the cost method or amortized cost for shares, we do not adjust to fair value. And then on disposal, we will record any accrued interest and discount or premium up to the date of the disposition. And then we will record the disposition . So when we record that after we do step one, then we would de-recognize the investment. So we would credit that investment account, that bond at amortized costs, and we would report gain or loss in net income. Okay. So that is the same as this step here for the amortized cost for shares. The only difference is we do not have that step one in that other model. Okay, so we had looked at an example for the cost method. We are going to do amortized cost for bonds. So we did the cost model for the equity instruments in the last video. Okay, and now we are moving on to amortized cost. Okay. Okay, so let's look at an example here. So January 1st, Graceco pays $92,278 to purchase $100,000 of Chocolate Co's 8% bonds. Okay, so we're purchasing 100,000 of the Chocolate Co's bonds. So that's the face value is 100,000. Maybe I'll put that over here, face value or future value. So the amount that we will pay at maturity will be that 100,000. Now the present value is what we will record the investment at today, and that is that 92,278. And typically we have to calculate it, and so it's very nice that in this example they gave it to us straight there. Okay, just a few other notes here. Few other notes is they use the amortized cost model with the effective interest method. So we'll look at that when we do our amortization schedule. Now, disposal, or here we're writing more information about the maturity. So the bonds mature on January 1st, 2025. And interest is payable Interest is payable each July 1st and January 1st. So semi-annual interest there. Okay, and then we are told that the lower than face value purchase price, so this purchase price of 92,278, that actually provides an effective interest rate of 10%. Okay, so effective interest rate of 10%. This is a combination of the 8% interest received in cash each year and the benefit of the 7,722 discount. Okay, so we know that the future value or the face value is 100,000, the present value is 92. So then the discount would be equal to 100,000 less our present value of that 92,278. So in this case, we have a discount because our present value is lower than our face value. Now, in cases where it is higher, where we're actually paying more for the bond than what we will receive, if the present value was higher than this face value, then we would receive more in cash today than we would have to pay on the maturity date. But in this case, we have a discount. And so this discount will actually have to be amortized over the course or over the life of the bond. So this 92,278, that's what the investment starts at, and over time it will reach that 100,000. So we'll look at that as well. Okay, so we have the effective interest rate of 10%, and then we are told that the market interest rate there is that 8%. Okay, so basically this type of bond would earn an interest rate of 10%. That is what we would call stated interest rate. And then this this rate of 8%, that's used for our cash payments. Okay, so now we'll fill in this. We will get to this disposal part in a little bit. Okay, but let's do the first steps before we touch on the disposal part, because it does get a little bit complicated there. Okay, so step one is to record the purchase of investment. So we had purchased that bond on January 1st, 2020. Now, because we purchased the bond on a date, on an interest payment date, therefore there is no interest accrual. So we don't have to worry about that. But remember here, with the amortized cost method, we would record the purchase at the investment at fair value plus transaction costs plus the accrued interest for bonds. Okay, and in brackets here, investment at fair value, I'm going to write present value. Okay. So in our cost model, we had debited other investments, but we are going to debit the bond investment, and we are going to record that it is at amortized cost. So always get in that habit of recording what model you are accounting for or using for accounting the investment at. Okay, and so now we are going to record the amount at the net cost, including transaction fees, if there were any. And of course, the cost may be higher or lower than the face value, which we already discussed. Okay, so they actually had given us the present value. So the present value was actually calculated to be 92,278. Now keep in mind that if you are given the $100,000 face value, you're not given the present value, but you are given the interest rates and the number of periods, then of course you are required to calculate that present value. And if you need help doing that, then you can go back to those previous videos on that section for calculating present values. Now, one thing to note about when they had calculated this present value, and you could do it as a test for yourself, is you need to calculate the present value of the annuity and the present value of the bond. Okay, so and then you have to add those amounts up, and that would equal the 92,278. Okay, so remember the present value of the annuity, you would need to record how much the cash payments are semi-annually. Okay, so to find out the payments, we know that the face value is 100,000. Then we multiply by our market interest rate, which is 8%. And then that would give us our $8,000 interest payments per year. Now, because our payments are semi-annual, we know that we need to divide that by 2, and then of course it's $4,000 semi-annually. So then you would use that payment amount, and you would go to your table for present value for calculating the present value of annuity, and you would make sure that you're using an interest rate of 5% now, because we would typically use the effective interest rate of 10%, but because it's semi-annual, we need to divide that by 2. So that was our 10% divided by 2 is our 5%. So we use the present value of annuity, and then we look up the factor using 5% and the number of terms. And because there's 5 years and payments are semi-annually, multiply by 2. Okay, so using that table, you would use 5% for your annuity, or for your interest rate, and a factor of 10. And then you would multiply that by your 4,000. So 4,000 by your present value of an annuity factor. Okay, so N is 10 and interest rate is 5. Let's just do a quick look here and see if we can pull up. While that's loading, whoops. I was going to do it another way, because you can do it equals present value of an annuity, but that, okay, so rate 0.05, NPER is 10 periods. Payment, this is our $4,000 payment. The face value is 100,000. And then we can put type, we can put 1 at the beginning of a period because they're paid January 1st and July 1st, I believe. Okay, 92. So that one gave me a slightly different present value there. Present value, 5%, 10 periods, $4,000 payment, 100,000. Okay, let's try 0. Okay, perfect. There we go. So this is how you can calculate it if you are using Excel. I just used a quick present value formula. As soon as you type in equals and PV, then you can start typing in your interest rate, your number of periods, your payment, and then that gives us our full present value, which is automatically calculating the present value of the annuity and the present value of the bond. Okay, so that is kind of the simplest way of doing it on the computer. Now I'm just going to put that up here, or maybe I'll put it down here. No, actually, I'll just move it over slightly. Okay. So now I just want to show you the table method if you're using that method. Okay, table of, oh, my internet is running really slow here. Table of annuity. Table value, oops, table of a new table value of present value of annuity. Okay, present value. And we were using, was it ordinary? 0. That was admitted. Type 0. Oops. So 0 is at the end of the period. Oh, so yes, of course that makes sense for why we had to put 0. And I made a mistake for putting 1 before. Okay, so that makes sense. Okay, so that is our ordinary annuity. Okay. And so again, we're looking for 5% and 10 periods. Okay, so I'm just clicking on a table here. If I, but for yourself, you can refer to the tables in the back of your textbook. Okay, so 5% and 10 periods, that's that factor there, 7.72173. So then I would go back here and I would multiply the $4,000 payment by the annuity factor of 7.72173, and that would give us Let's put a comment in between there. That would give us 30,886 or 887. Okay, so that is the present value of the annuity. Now we would have to do the present value of the bond and then add them up together, and they should equal that 92. So present value of the bond, now we're using the same factors, the n equals 5, or sorry, the n equals 10 and the interest rate will equal 5, and now we're just using a different table. So table value of a present value of an ordinary annuity is what we were using for those annual, or sorry, those semi-annual payments. So remember, an annuity is something that comes annually, or in this case, semi-annually. So that's why we were using that table. Now we will need to use the present value of a single sum. Okay, so we will use that one for present value of a single sum. Oh, that one doesn't have 5%. Let's look at this one here. So now we're looking again at 5% and 10 years. So here's a 5% and 10. This chart is really hard to read, so again, if I were you, I'd refer to my textbook. This is 0.6. Ooh, what is that? I can't see if that's an 8 or a 3. 6, I think it's a 4. 4381. Oh, it might be a 161. Let's check another table really quick. This one is 5%. I'm hoping it, oh, that one doesn't have 5%. Okay, here's 5%. Oh, this one's nice and clear. 5%, n equals 10. Oh, this is the future value. That's the wrong table. We need the present value. That's why. Okay. We could use a formula, but I just want a nice table here. Let's look at this one. Okay, well, we can't quite read it there, but I think it was 0.61. So let's try that. So to find the present value of the bond, we would take the face value of that 100,000 multiplied by this 0.64, or was it 61? 0.61381. Okay, and now don't be alarmed if these don't perfectly add up to the 92, because I could have made a little mistake when I was copying those numbers. Oh, perfect, 268. So that I would just, the little $10 difference, I would just chalk up to rounding differences, or it could have to do with this number. Oh, no, it wasn't that. Being calculated differently, but I think that was a 1. So we'll go back to when I had that 1 in there. Okay, so we just did a proof there of that present value. So that's how you would have calculated it if they had not given you that present value. Okay, so you can see that it's quite, it's much easier to do it here in Excel than the tables, but of course the tables is good to learn as well. Okay, so I think we're going to pause here for, or let's just finish this first journal entry. Shh, yeah. So we'll just finish this quickly here. So the 92,278, we're using this calculation here that they had given us and what we had calculated here. And we had pretty much proved it there as well. That I would just chalk up to small rounding error, and I definitely wouldn't deduct for that as long as the method is correct. Okay. And we will stop there